So when it comes to rolling, is it a debit or a credit? Happy Monday to all of the option traders out there. And this is a question that I get a lot from traders when they're trying to roll one leg or maybe even several legs of a position, either up or down. And they'll say, I don't really know if it's going to be a debit or a credit. And if they play around with it for a little bit or maybe put up a simulated trade, they can figure it out. But there's a couple of really easy ways to just look at the strategy and figure out if it's going to be a debit or a credit. So let's go find out how it's done. And as always, before we get started, please be sure to click like and subscribe. It's very much appreciated and definitely helps to promote the channel. So when it comes to rolling, the premise really that we're looking at here is that traders get confused when rolling long or short positions. And this is especially true for the more complicated positions, such as your condors, short iron condors, things like that. But they're easy to understand by looking at your pricing principles. Now, we've covered these in the past, and there's one in particular that we're going to be looking at. And then there's a second method that you can do by understanding risk and reward. So these are the two ways that we're going to use to figure out if it's a debit or a credit. We're going to fall back on one of our pricing principles, and then we're going to look back at risk and reward. So what is the pricing principle that we're talking about here? Well, the one that you have to understand says that lower strike calls and higher strike puts must be more expensive. So for any given underlying and any given expiration, if you look at two calls or two puts, then the lower strike call or the higher strike put must be more valuable. So as an example, if we're looking at the $100 call and the 105 call, you know that the $100 call has to be worth more money. If we were looking at the $100 put compared to the 105 put, the 105 put must be worth more money. It's the higher strike. So let's take a look at an example of a credit spread. And I chose this because this is one in particular where traders get kind of confused with these rolls. But let's say that we sell the $100 call and we buy the 110. So it's a 10-point spread and we get a net credit of 5. This is our risk profile. So like I always point out, right here is our bend at the short 100 strike. We get another bend at our second strike here, 110 in this case. So we have a short 100 call and we have a long 110. So when you're looking at your graph like this, you can see that the strikes for the calls are going to get more expensive or more valuable as you move to the lower numbers. They are going to therefore get less valuable as we move this way. Now, if this spread were constructed with puts, it would be just the opposite. We would get more valuable as we move to higher strike puts and less valuable as we move to lower strikes. But for this example, we're just assuming that these are calls. So let's say we wanted to roll this short 100 call down. For some reason, we just want to roll it in this direction. And again, traders go, gee, is this going to be a vertical spread as a debit or a credit? Well, just think about it. If you have the 100 call short and you're trying to swap it out with, let's say, the 95, that is a more valuable option. It's going to be a credit. And so what's the trade? Well, you would simply buy back the $100 call and perhaps sell the 95. That trade right there is selling the 95-100 vertical spread. And yes, it's going to be for a credit. But instead of having to go through these steps and to say that, okay, after I place this credit spread, these are going to cancel out and I'm therefore going to roll from the 100 to the 95, you should be able to just look at it and tell that it's going to be a credit. Now, what about this 110 strike? What if you wanted to roll that down as well, maybe to the 105? Is that going to be a debit or a credit? Well, again, think about what you're doing. This is a position that you own, it's long, and you're trying to swap it out for something that's more valuable. You're trying to roll it in this direction. That's going to be a debit. Very easy to look at and see. Now, if you wanted to step through the motions, the trade you would place is to sell the 110 to close that one, and then replace it, let's say, with the long 105. And of course, that's buying the 105, 110 vertical spread, which is a debit. And once that trade executes, those cancel, and you've therefore rolled to the 105 strike. But once again, rather than having to go through the motion of simulating a trade like this to figure out if it's a debit or a credit, just think about which side of the board that you're moving towards. Are you moving towards the more valuable side or the less valuable side? If it's a credit, if it's the short position up here and you're moving to the more valuable side, it's going to be a credit. If you're talking about a long call and you're trying to move it towards the more valuable side, it's going to be a debit. Now, what's another way that we could look at it? Well, we could do it in terms of risk and reward. Whenever you sell an option, you are accepting risk. And so if you are willing to sell the $100 call, that's one level of risk. But if you're willing to sell a lower strike call, that's riskier. It's more likely to go in the money. That's what gives it more value. And so if you are willing to accept more risk, the market is going to pay you for that. That's another way to understand why that's got to be a credit moving in that direction. What about down here for the long position? Well, it's a long option. You bought it. And if you're trying to move this way, why would you be doing that? It's because you're trying to buy an insurance policy. See, right now, you could end up with a loss as the stock price moves all the way down this line. But if you've got the 105 strike, it's going to stop up here. So if you are rolling to the 105, that's actually a bigger benefit for you. And so what you're trying to do is to kind of stop the bleeding here instead of at 110 to make it seal off at 105. And that's what's going to give you less risk. And so if you're trying to reduce the risk, or in other words, that's a bigger benefit for you, the market's going to charge you for it. And so that's another way to see that it must be a debit to roll from the 110 down to the 105 call. So I just thought that would help the traders out there. I know a lot of times traders are trying to roll positions or different legs or wings of the condors and butterflies, and they get really confused about whether it's going to be a debit or a credit. And so hopefully this will make it much, much easier just by looking at your risk graphs, or even better, if you can visualize the risk graph and figure out if it's a debit or a credit. And the faster that you get at decisions, the better you're going to be at trading. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z's Facebook trading group, where you can find all of the archived videos from our trading group. And you can find a link in the description below.